The Fed's official balance sheet is up another $104 billion this week. We are now over $8.2 trillion on the Fed's official balance sheet. Off balance sheet in special purpose vehicles, who knows exactly how much is off balance sheet. But this tweet recently in the last 5 or 6 days from hedge fund manager Tavi Costa, who I've interviewed in the past on my YouTube channel. You can go in the archives. I love his interviews. Some of the best global macro charts out there for free if you want to follow him on Twitter. The U.S. Treasury has just issued over $1 trillion worth of bonds and notes just in the last 4 months, largest amount for such a period of time ever recorded in history. And then you have Congress, which was talking about a $1.2 trillion quote-unquote infrastructure plan. Now the new number seems to have ballooned to $3.5 trillion. Now we'll see what ends up happening with the real number. If the real number is closer to $1.2 trillion, but it is an enormous increase of over $2 trillion that suddenly appeared just in the last couple months. Maybe it's being added to the real inflation rate. Maybe that has to do with the actual inflation rate, how it's double digits, and it's just compounding that 1.2 trillion number. It's just accelerating, and they're adding real inflation to it. The U.S. federal government is spending enormously. Tax revenues are obviously not going to cover it, so this is stagflate tax lie. And we are also seeing very unusual behavior and comments and actions from a lot of the large U.S. banks. So Wells Fargo abruptly ended personal credit lines. We have weird comments from CEO of JP Morgan, Jamie Dimon, talking about how they want to hold even more cash because of inflation, which doesn't make any sense because normally the longer you hold cash in an increasingly inflationary environment, the worse off you're going to be. So hoarding lots and lots of cash, unless you think the stock market's going to crash over long periods of time in an inflationary environment, is not a good idea. You also have the JP Morgan news about enormous amounts of margin calls intraday now, up to 7 times checking on hedge funds. Well, if they were going to give out that much margin debt and credit to hedge funds and checking margin debt, they shouldn't have given out the credit in the first place. That's my opinion. So if they were going to be prudent, they should have never given out the credit in the first place. But that's not the way our fiat currency and credit Ponzi scheme works, because within a couple months after February and March of 2020, after bond markets and credit markets froze up and the Fed had to issue press releases guaranteeing things and all the alphabet super programs, within about 2 or 3 months, the amount of junk bond issuance and derivatives and credit and corporate debt exploded, started to increase rapidly again. We had record amounts of junk bond sales within a couple months after February and March of 2020, and it just keeps growing. And yet there's no cash flow to pay back that debt, and there's not even really cash flow to service the debt. So that's how bad the Ponzi scheme is. So can this Ponzi scheme actually be tapered? The Fed can pretend that they can taper. The Fed can pretend that they're going to do some interest rate hikes 18 to 24 months from now. Maybe they will actually do 1 quarter point hike, but then they're risking blowing up lots of over-leveraged hedge funds and family offices and portfolio managers, bond fund portfolio managers at banks who are doing these massively over-leveraged trades on leverage short vol and other trades. And for the people out there who think that this is just GameStop and AMC theaters, those trades are tiny compared to the leverage short vol trade. The leverage short vol trade is in the trillions. If you don't believe me, go and listen to volatility hedge fund manager Christopher Cole of Artemis Capital, who has detailed this better than anyone on the planet. The leverage short vol trade and all the other trades that are attached to it are in the trillions. So that is one of the largest over leveraged trades besides the passive investing bubble with index funds. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth content, research, information, financial education, and analysis than I can provide in this short little video, my articles behind the paywall over on my Patreon are far, far more in-depth than this. There is over 170 articles, charts, and audio podcasts behind the paywall for my patrons for only $5 a month. It is one of the best deals out there. If you don't like it, you can always cancel. Although I'm charging less than anyone in my space for premium content, far less actually, because I want to provide people with really good quality information at an affordable price. Unlike a lot of my competitors that will charge $500 or more per year for less than quality information, often pumping junior mining stocks. And just in the last 7 or so weeks, there is 17 new articles on a lot of global macro topics, companies and sectors, in-depth articles, including this silver miner that everyone else seems to really, really like, but they just bought a gold mine recently, and now their costs in the last 18 months are up 30%, according to the company's own website. Investors' presentation filings, they have disclosed that their all-in sustaining costs are now up 30% in the last 18 months. The management team is not doing a wonderful job with controlling costs. It is a big red flag to me, and something that other analysts just don't cover enough. You won't see it on Seeking Alpha. Analysts do not do a good job over there of tracking management teams at mining companies, whether or not they can actually control costs. And I think that is one of the most important things for a mining company, especially where they don't get to control the commodity price. The mining companies do not hedge energy input costs, often because it's too expensive for them to pay up front for a lot of energy hedges, oil and energy hedges. And so tracking management teams, checking to see if they can control the costs, not seeing big cost spikes, is important to me. And that is another reason why over the long term, in different parts of the cycle, the larger precious metal royalty and streaming companies are far superior businesses and far safer, and that's why I can sleep at night with my own investment portfolio instead of owning a lot of mining stocks that can have costs run out of control in only 6 to 12 months.